Hi friends, welcome to EduTap. So today we are going to discuss some important MCQs based on a very important concept of accounting. We are going to talk about debit, credit, and we are going to talk about maintenance of accounting records, how the accounting cycle works, how the entire process of accounting works in all its practical aspects. We are going to discuss about it. So let's start today's discussion. So friends, let's start our today's discussion with the first question. Increase in which of the following is debited while recording transaction in the books of accounts? So when we record the transaction in the books of accounts, what we are doing? We are doing debit and we are doing credit. We are going to do debit as well as credit. Now what are these debit and credit? So in very simple terms, what should I say? I should say that they are plus and minus of accounting. So in maths we have plus and minus. In accounting, we do not have plus and minus. We have only debit and credit. So everything that is going to happen, we are either going to debit it or we are going to credit it. So this question is basically stating that increase in which of the following is going to be debited: assets, liability, income, capital, or none of the above. So to answer this question, you should be aware about the basic rules of debit and credit, and they are very simple to remember. So let's take a look at them. So let's talk about the much hyped rules for debit and credit. Now debit and credit, they are the language of accounting. So in accounting, we do not have plus and minus. Like in maths, we have plus minus to show things. But in accounting, we do not say plus minus. Accountants, they are sophisticated people. They say sophisticated things. They use the words debit and credit. They do not use the words plus and minus. So what are the different rules for debit and credit? Before we understand them, I have a small request to make. Just do not confuse, just do not bring any of your preconceived notions that you have about the debit and credit, including what you have seen in the passbook of your bank. There are debit and credit columns in the passbook as well. Just forget about them for the time being, and let's just simply take a look at what are the rules for debit and credit so that I can explain them to you in the simplest possible manner. So these are the rules which are there. The students who like to cram things, they can simply cram this particular table and the things are done. But the students who would like to have some sort of understanding, let's also try to address them. So as already explained to you, in accounting, there is no plus or there is no minus. No plus and no minus. So how the transactions are recorded? Transactions are recorded as debit credit, plus transaction can be debit credit, and even a minus transaction can be debit or credit. So if you learn one, you will be able to learn everything. You will be able to learn all the rules. So let's just learn one, that if an asset is increased, it is debited. It is debited. Plus in asset, it is debit. If your furniture is increasing, you are going to debit furniture. Now if increase in asset is debited, what you are going to do with increase in liability? You are going to do the opposite. You are going to credit it. Increase in asset is debit, increase in liability is going to be credit. Now capital, it is always shown along with liabilities. In the balance sheet, what is done? In the balance sheet, on the one side we have the assets and on the other side we have the capital and we have the liabilities. So for capital also, the rule for liability is going to apply. Increase in capital is going to be credited. So that you can also see here. Now if I say any income that the business is earning is a liability for the business, because the business is earning this particular income for its owner, for its shareholders. So this income has to be ultimately given to the shareholders. Business is making this income, but it is a liability for it. Is it correct? So definitely it is correct. We already know about the business entity concept. So now what we do with the liability? We credit the liability. Increase in liability is credited. So any increase in income is definitely going to be credited. Any increase in income, any increase in revenue, it is going to be credited. And similarly, for expenses, the things are going to be opposite. For expenses, what we are going to do? We are going to do debit. For income, credit. For expenses, debit. So I just told you to learn about the asset. Increase in asset is debited. So you learned about it. Liability and capital, opposite. Increase is credited. And income is also a sort of liability. And again, it is going to be credited. And expense is going to be opposite, that is debited. So we know about we know about that this particular side of this particular table. Now, what about the decrease? Now this decrease you have automatically learned. How you have automatically learnt it? Now increase in asset is debit, so decrease in asset is going to be credit. So opposites are going to be here. Increase in liability, it is credit, so decrease in liability is going to be debit. Increase in income is credit, so decrease in income is going to be debit. Increase in expenses debit, so decrease in expense is going to be credit. So everything is going to be opposite here. So you just had to learn one. You just learned that increase in asset, it is debit, and automatically every other aspect, every other rule for debit and credit, you have automatically learnt about it. If you try to learn in this particular fashion, I believe it is very simple to remember all the rules of accounting. I always remember about the asset only, and I do not have to learn about any other rule. I just automatically make out what the other rule is going to be, what I am going to do with the other set of the transaction. So this is what you have to remember, and with remembering this particular part only, all the rules for debit and credit are going to be crystal clear to you. Just take a minute, just pause this video, just think about it, just try to revise all the rules once in your mind, and then proceed to the answer for this particular question. So now let's try to answer this particular question. Increase in which of the following is debited while recording transactions in the books of account? Asset, liability, income, capital, or none of the above. So let's just try to make a table out of it. Okay, increase and decrease. You should try to make this table in your mind or in your copy. That would be way better. We have asset, we have liability, we have capital, we have expense, we have income. Okay, increase in asset, we have learned it is going to be debit. So liability, credit, capital, credit, expense. So income, we know income is credit. Income is kind of a liability for the business. So credit, and expense opposite, that is debit. Now decrease is simply going to be opposite. Here it was debit, here credit. Credit, debit, and credit, debit, debit, credit, credit, debit. So we have already prepared this table in less than 30 seconds, I guess. So we are being asked which of the following is debited. Increase in which of the following is debited. So we have to see the increase column, and the asset increase, it is debited. Yes, it is debited. Increase in asset is shown as debit. Increase in liability, no, it is not a debit, it is a credit. Increase in income, it is a credit. Increase in capital, it is a credit. So clearly the answer is going to be option number A. So now let's move on to the next question. Which of the following correctly depicts the sequence of events involved in accounting cycle? So when you are accounting, you are recording the transaction in the books of accounts, and there is a proper cycle that follows. So first you go to this step, second this, third this, and finally your final accounts are going to be ready. So we are being asked about what is the correct sequence of those events which are going to happen. So there are going to be basically 4 events. One is journal entries, one is trial balance, one is ledger, one is final account. So you just have to spot the correct arrangement from these particular options. Now to answer this question, we have to understand about the sequence of events which are involved in recording of the transactions and finally reporting them in our financial statements or final accounts. So this is what the accounting cycle looks like. So it starts with the recording of the monetary transaction, and it ends with the preparation of the financial accounts, the financial statements, the final accounts. So the final accounts, they are what? They are profit and loss account and they are balance sheet. So these are my final accounts. These are the financial statements that which you basically find in any annual report of the company. So if you are taking a look at the annual report of a company, you would definitely find these financial statements, profit and loss account and balance sheet. But do remember that preparing these profit and loss account and balance sheet, they have just shown profit and loss account on one page and balance sheet on another page. It was not very easy. It was not just a page work. It was not just an hour or day's work. It was the work of an entire year that is being shown in this profit and loss account and the balance sheet. Now the transactions, they were not automatically entered into profit and loss. They were not automatically entered into balance sheet. A sequence of events happened, and at the end of the year, the transactions automatically followed to profit and loss account, which is popularly also referred to as the P&L account. It is also referred to as the PL. We also refer to as PL or P&L, and balance sheet, we sometimes say it as BS. So we have to reach this P&L and balance sheet. Now how we reach it? Let's try to understand it. Now this accounting cycle, it states that first what you have to do, you have to record monetary transactions. We already know non-monetary transactions have no place in the heart or the books of accountants. Accountants are only concerned with money. बस पैसा, उनको बस पैसा समझ में आता है. Now the first step is journal entry. Now journal is what? Journal is basically, you can take it as a diary. So in the diary, you are recording all the transactions in a chronological event. You are recording all the events in a chronological order. Like at the end of the day, you write something in your diary. So daily you put in the date and you write the events of the day in the diary. So similarly in journal, what we are doing, we are recording the events of every day in this journal. We are putting in date. So suppose, let's talk about any particular month, any particular year. So let's talk about the month of February. Now this month of February, why I have picked, I will tell you later. So this, what happens is, suppose in the month of February, I'm expecting huge sales of iPhones. I expect huge sales of iPhones are going to be there because it may be a festive season for some people. So what happens on 1st of February, I bought certain phones. I bought say 10 lakh worth of iPhones. Now again on 5th February, what I did, I thought that I should also make my shop look good. I spent 2 lakh on furniture. Now again on 11th Feb, I thought again I should spend some on furniture. I bought 1 lakh worth of furniture. And 14th of Feb, I made huge sales. I made 12 lakh sales of the iPhone, 12 lakh worth of sales of the iPhone. So these are the events that are happening in a particular month. So in my journal, I'm going to record all these events. On 1st of February, I'm going to write, okay, I bought this much of iPhones. On 5th, I would say, okay, I have spent 2 lakh on furniture. On 11th, I have spent 1 lakh on furniture. On 14th, I have sold iPhones worth rupees 12 lakh. So I'm simply recording all the transactions in this journal. So on a daily basis, there may be several transactions which are happening. If you consider the transactions for the whole year, it may be hundreds or it may be thousands of the transactions which are happening during the entire year. So they are all going to be recorded in a chronological order in this particular book, which is referred to as journal. We are going to make an entry. We are going to enter all the transactions in this particular book in a chronological manner. And that's why we refer it to as a journal entry. We have made an entry in our journal. Now, the problem with journal is that it is a chronological record, but it does not tell us about any particular thing that we want to know about. Suppose at the end of the year, I want to know about the furniture that I have purchased during the year. So I cannot just skip, I cannot just like pull over pages. I cannot just glance through my journal to take a look at when the furniture was purchased. I should have a one page. I should have something. I should have a separate record of furniture which should tell me that, okay, this furniture was purchased on this date and this furniture was sold on this particular date. How much of furniture I'm having as of now. We should have a separate record of it. And this record is maintained in the form of a ledger account. So what I'm going to do, I'm going to open ledger accounts. I'm going to open a ledger account of purchases. I'm going to open a ledger account of sales. I'm going to open a ledger account of furniture, of cash, of bank, of everything pertaining to the business. I'm going to open a ledger account. So whenever I open the furniture account, I would be able to see, okay, these are the transactions related to the furniture. I would see, okay, this much of furniture I have purchased, this much I have sold, and this is the closing balance of furniture that I am still having with me. So all the records pertaining to furniture are going to be in this particular account. So ultimately from journal, we move on to ledger. So after entering it into journal, we also enter into a ledger account. Every transaction would have certain accounts which are being impacted, and in those accounts which we are also going to record this particular transaction. If you are using an accounting software, you only have to make an entry in the accounting software and all the steps they are automatically done. You do not have to do anything. You just have to make a journal entry and your financial statements, they are ready then and there. So this ledger and trial balance, they are just for those who are doing manual accounts, which as of today, nobody is doing. So after we are done with the ledger accounts, we need a statement which should show us all the balances of the ledger accounts. There may be hundreds of ledger accounts with me, and I want to know at the end of the year, what are the balances of all those ledger accounts. So I'm going to prepare a trial balance. In this trial balance, I'm going to record, okay, this is my cash, this is my furniture. I'm going to record all the balances, the debit or credit balances, all they are going to be recorded in this particular trial balance. So trial balance is basically what? It is a snapshot of the closing balances of all the accounts that you have opened. and ultimately this trial balance has to balance out. The total of the debits and the total of the credits have to be equal, because every transaction, it has two aspects. If you have recorded every transaction correctly, the total of the trial balance must match. And from this trial balance, what do? You pick out the items which have to be transferred to profit and loss account, and you pick out the items which have to be transferred to balance sheet, and your financial statements, they are ready. For example, the purchases, the sales, the salaries paid, all they are recorded in the profit and loss account. And the furniture that I am having, the cash balance, the bank balance, the capital account balance, the liabilities that I have incurred, they are going to be recorded in the balance sheet. So from the trial balance, we ultimately move on to profit and loss account and our balance sheet. So now I believe I have spent considerable amount of time in explaining you the accounting cycle, and now we can easily answer this. That first we are going to make journal entries, and then we are going to move to ledger accounts, and then we are going to move to trial balance, and then our final accounts are going to be ready. So the correct answer is going to be option number B. So friends, let's move on to the next question. The question is, credit sales to Mohan rupees 10,000 were not recorded in the books of accounts. This is an example of error of commission, error of omission, compensating error, error of principal, or none of the above. So while recording transaction in the books of accounts, you may commit different errors. Now these errors, they are classified as commission, omission, compensating, or error of principal. So you have to understand what these kinds of errors are, and then accordingly you would be able to make out the right answer for this particular question. So friends, there are four kinds of errors which may be there. Number one, error of commission. Now these errors, they are committed due to different reasons. You made a wrong posting of the transaction in your books of accounts. You made a wrong total of the account that you had. Of the subsidiary book, for example, purchase book, you made a wrong total of it. Wrong casting simply means wrong total of it. You wrongly recorded the transaction in your books of original entry. Book of original entry is nothing but your journal only. So these errors are referred to as the errors of commission. Now, then is error of omission. Omission itself means that we have omitted something. A transaction may be completely omitted. We bought some furniture from Mr. A worth rupees 1 lakh. We completely omitted the transaction from the books of accounts. Now it may happen that we recorded this transaction partially. We recorded the purchase of furniture, but we forgot to post the entry also to Mr. A's account. So this kind of omission is called as the partial omission. Then is the error of principle. Now we have to follow our general accounting principles. If we do not follow those principles, we are going to make an error of principle. For example, you bought a machine worth rupees 10 lakh. You spent 1 lakh on its installation, transportation, etc., etc. You had to record the machine at 11 lakh. What you did? You recorded the machine at 10 lakh and you transferred this 1 lakh to another set of different accounts, ultimately to P&L. So this is wrong. This is what you have done. You have done an error of principle. You did not follow the cost principle about which we learnt about in the previous class. So if any of the accounting principle is violated, you are committing an error of principle. Then is compensating error. Now compensating error, it is very interesting kind of error. So what you are doing, you are making two errors and one error is compensating another error. So you bought furniture from Mr. A. You bought furniture from Mr. A worth rupees 1 lakh, and you bought furniture from Mr. B worth rupees 2 lakh. What you did, you made opposite entry of the transaction. You recorded 2 lakh in Mr. A and 1 lakh in Mr. B. So these errors, they are ultimately going to compensate. At the end of the year, our liabilities are only going to be 3 lakh. But in the figure of the liabilities, some errors have been made, but they have been compensated in the final figure. In the trial balance, they have been compensated like this, that we are not going to spot. We are not being able to spot, okay, that this kind of error has been committed. The ultimate effect of this error is null. Ultimate effect is nil. These are the compensating errors. So there are the four types of error: commission, omission, principal, and compensating error. So friends, now we can easily answer this question, that credit sales to Mohan were not recorded in the books of accounts. So this is quite clearly an error of complete omission. We have not recorded this transaction completely. So this is complete omission. This is an error of omission. So answer is going to be option number B. So let's move on to the next question, which is not correct about balance sheet. Balance sheet shows position of the business on a particular date. Assets, liabilities and capital, they are shown in balance sheet. Accounts shown in balance sheet are carried forward to next year. It is prepared before the preparation of the profit and loss account, or none of the above. So we know that there are two kinds of financial statements. There are two kinds of final accounts that are very important. One is the profit and loss and another one is balance sheet. So if you are aware about the differences between the two, you would be able to easily answer this particular question. Now let's take a look at the differences between the balance sheet and the profit and loss account. Now a balance sheet, what it does, it shows the balances of different items, balances of different accounts at the end of the year. So it is going to show you your cash balance, your bank balance, your furniture balance. It is going to show you the balance of your capital account, the balance of the creditors that you have to make payment to. So all these balances, they are going to be there in the balance sheet. And in the profit and loss account, you are going to record all your expenses and your incomes. So this is the meaning of the two. Balance sheet is basically a kind of a statement, and profit and loss account, it kind of looks like an account with debit and credit. Although now in the financial statements of a company, P&L account is also prepared in the form of a statement, but conventionally, traditionally, profit and loss is referred to as an account with debit and credit. Balance sheet, it represents the financial position of the business. It shows what is your position with regard to assets and liabilities. And P&L, it shows the profit earned or the loss incurred during the accounting period. Now a balance sheet is prepared as on the last day of the financial year. So whenever you look at a balance sheet of any entity, you would say balance sheet at 31st March. Whenever you look at the profit and loss, you would see profit and loss for the year from 1st April till 31st March. So profit and loss is for the financial year and balance sheet is on the last day of the financial year. Information which is shown in the balance sheet, your assets, liabilities, capital is going to be shown, and in profit and loss account, your income, expenses, gains and losses, they are going to be shown. And the accounts which are shown in the balance sheet, the cash, the furniture, the creditors, the capital, they are again going to be carried forward to the next year. But in profit and loss account, whatever the accounts that you are putting in, they are going to be closed. They are not going to be taken forward to next year. Next year, we are going to have a separate set of transaction, a separate set of salaries are going to be paid. Everything separate is going to be there. Now all the balances for that year, they are going to be transferred to profit and loss account. When we talk about the sequence, profit and loss account is generally prepared first, because we need to know the profit that we have made, and this profit is again ultimately taken to the capital account. This profit belongs to the owner of the business, owner of the company, and this is again taken to the capital account of the owner. So this is how the flow of transactions is occurring, the flow of events is occurring. You are first preparing your profit and loss account, you are knowing your profit, and this profit is again taken to the capital account in the balance sheet, and then your balance sheet is completely ready. So this is how the sequence is to be done. So now we can easily answer this particular question, that balance sheet is not generally prepared before the preparation of profit and loss account. It is prepared after the preparation of profit and loss account, because we have to know the figure of profit so that we can take it to the capital account, and this capital account balance is going to be shown in your balance sheet. So answer is going to be option number D. Now let's move on to the next question. Now this question is, Rohit started business with rupees 5 lakh as cash. Now in this transaction, which account is debited and which account is credited? So already we have seen the basic rules of debit and credit. Now I believe it must be very easy for you to answer this particular question. Now first and foremost, you have to understand, you have to take a look at the things from the perspective of a business. Just follow this particular philosophy and you will be able to identify what is to be debited and what is to be credited. So the options are cash account debit, capital account credit, cash account credit, capital account debit, Rohit account debit, capital account credit, cash account debit and bank account credit, or none of the above. So let's try to analyze this transaction from the perspective of a business. Now for this particular business, what is happening? Cash of rupees 5 lakh is coming to the business, and also in the capital account, rupees 5 lakh are coming. Rupees 5 lakh is increasing. Now cash is an asset. Increase in asset what it is shown as debit. And capital, increase in capital, it is shown as credit. So we are going to debit the cash account and we are going to credit the capital account. We have already seen how the transactions they are recorded in the books of accounts. We have already seen how the rules of debit and credit are to be applied for different assets, liabilities, income, expenses for different set of transactions. So now we can easily answer that you are going to debit the cash account and you are going to credit the capital account. So I believe you all have answered this one correctly. Cash account is debited, capital account is credited. The answer is option number A. So thank you friends. This was our today's discussion on debit, credit and recording of transaction in the books of accounts. I've tried to explain everything in the simplest manner possible. And if I have been able to explain to you all the different basic aspects in the easiest possible way, if you are able to understand them, don't hesitate to shower your praise in the comment section. That's it for today. Bye bye. Take care. All the best.